Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is May 19 and this is a weekly markets update. Let's have a look at the news of week 20 and see what are the next trends. Last week, we haven't met with you here at Fertilizers Jazz because I was visiting IFA annual conference in Monaco, same as thousands of other industry participants from all over the world. Thank you to all my partners and colleagues who took time and met with me during the conference, shared valuable insights, and just spent a couple of minutes to exchange recent news in person. I was very glad to see you all, and thank you, gorgeous Monaco, for hosting us. The key topic of discussions in the conference was about China and its export policy. On Friday, more details about the policy were revealed. Chinese government wants to make sure that exports will be conducted in the organized way that will not collapse market price and will not negatively influence domestic situation with supply and prices. So, the government has put a volume and price target for the export. In terms of volume, the maximum amount will be around 2 million tons, split between several key producers. Shipments will be conducted in two windows, May-July and August-September. Custom inspections should be conducted within 10 days. There will be strict control over the importers to keep the agreed quotas, price level, etc. As for information available at the moment, no exports to India will be allowed. In terms of target FOB price level, it will be $370 FOB for granular product and $360 FOB for prills. What does that mean for the international market? First of all, 2 million tons is much less than expected, meaning that pressure at supply-demand balance in the international market will be less severe. However, if there are no shipments to India, it will significantly limit geographical reach of Chinese products, and especially for prills that can find home perhaps only in Brazil. Second, price cap of Chinese government is extremely high, even in the current market conditions, not talking about moving further into June onwards. Either the cap has to be decreased or it will be extremely tough to sell at this level literally anywhere. So from one hand, such approach might support international price level in summer, not letting it drop too much. But still, volumetric pressure will be there, and for me it is difficult to imagine now many buyers ready to purchase at such high levels. So let's watch how the situation develops. Apart from that major news, there was not much activity happening in the market last week. Egyptian producers conducted a small sales of 5,000 tons at $390 level. However, definitely the general market level and sentiment is much lower than this figure. Rumors about production cut in Egypt due to gas supply issues seem to be not real, so I believe Egyptian producers will be struggling to find more support for such high prices later in May and June. Iranian producers held tenders with target price of $345 FOB, but it was scrapped as no buyers were ready to engage at that level. Ethiopian ABC closed its tender for more than 500,000 tons of urea and received offers for all lots. The majority of offers indicated supply from the Middle East at price level of $388 to $97 FOB. Egyptian product was proposed at mid-$400 FOB level. Indonesian Pupuk closed a sales tender on Friday for 45,000 tons, and the highest bid is understood to be $367 FOB. Last tender was nominated at $402 FOB, and this time producer was targeting to get not less than $395. Tender result confirms that clearly current market level is much lower versus expectations or targets of producers floating, and very soon the market will see significant correction. One more important topic that was widely discussed in Monaco was Indian tender, of course. Here, market participants' expectations differ. Some say that the tender might appear as soon as end May because Indian government is struggling with DAP purchases and purchasing more urea instead will help to balance at least nitrogen part of the equation. Others still hold to the thought that tender will not come earlier than second half June because current urea stocks are healthy and Indian government is not in rush. Whenever it appears, the tender will support the market, so international price bottom will depend on the tender timing and volume, of course. Paper values again moved nervously. Egypt FOB future price for May remained largely unchanged, while for June and July increased by $15 to $20. Arab Gulf FOB future price fluctuated plus minus $5 for all months versus a week ago. Brazil CFR also dropped from May, but increased significantly by $25 to $30 for June and July. NOLA value after a huge spike corrected downwards for all 3 months, which was expected. In ammonium sulfate, activity was subdued as the market was expecting urea news from China in order to identify direction. Chinese copper grade price remained unchanged at the level of $152 to $57 FOB. The nitrates market similarly was on pause. The only significant news came from Yara, which announced new season prices for ammonium nitrate and CAN. AN price CPT in France was indicated at €360, while CAN CIF inland price to Germany and Benelux was indicated at €282. This level is more than €20 lower versus last deals conducted. However, many market participants noted that the level is high to push stocking campaign for 25-26 season. Still, some purchases emerged last week. Activity in UAN was mostly happening in the US, where prices surged a bit more last week amid thinning supply and healthy demand across the Corn Belt. Supplies are expected to remain high during current pre-plant and even top dressing season that will last until mid-July. It is a very challenging situation for the US farmers, of course, with historically high corn acreage needed to be fertilized. Ammonia market trend after IFA conference is still bearish, with supply significantly surpassing the demand. In the Middle East, more than 7 weeks turnaround is supposed to bring some relief. However, market players are not sure if it helps to stop price deterioration. In Asia, further price decline will bring sales price lower than the cost, so perhaps turnarounds are inevitable. At the same time, spot demand from India is extremely limited and cannot support the market. Chinese caprolactam production continues suffering, so no support from the industrial sector to expect as well. West of Suez last week, there were 2 spot activities registered. CF purchased 12,000 tons of Algerian material, and LAT Nitrogen purchased 10 to 12,000 tons of Russian material. Price level for both deals is not available. In general, European CFR price now is evaluated at the level of $420 to $50 CFR, while Middle East level is around same $270 to $310 FOB versus last week. In the phosphates market, Chinese export policy and affordability issues were dominating discussions in Monaco. On Friday, Chinese phosphates export quota for 2025 was revealed. It will make 3.5 million tons in total, split between 1.5 of MAP and 2 million tons of DAP. Same as for urea, minimum FOB price threshold was set, and it is on the level of $680 for DAP. Shipment period will be May to September, and no exports to India allowed. In India, despite the government efforts to control increasing DAP prices, fresh purchases are concluded at much higher versus target cap. Last week, Russian cargo of 30,000 tons of DAP has been sold at $729 CFR for end May shipment. DAP offers have also been heard higher at $700 high 30s level CFR, while buyers' counters were at high 720s. This week, 3 tenders will be closed from NFL, RCF, and HURL, each for 100,000 tons, so we will see the new actual price level. Indian stocks are evaluated now around 1.1 million tons, so expectations are that DAP prices will continue to rise in upcoming months at least. Pakistan stocks in front of the season are low, same as in Bangladesh, but affordability there is a concern. Pakistan, several importers are thinking to go for a couple of cargoes for June onward shipment, but yet to issue concrete inquiries. In Brazil, prices continue to rise as well. Fertipar purchased last week 7,000 tons of MAP at $715 CFR, likely June-July loading. At the same time, OCP offers are at higher level, up to $740 CFR, with no sales confirmed though. DSP offers are tight, price indications heard at $580 CFR. Brazilian buyers perhaps have already purchased around 70% of their seasonal need, but affordability issue put under question for the purchases. In the US, NOLA MIP barges traded around $665 to $75 per short ton for prompt and May loading. Nothing on DAP so far. Market players are extremely concerned about phosphates affordability that is leading quickly to demand destruction. Also, continuous tariff story doesn't add optimism, as anyway phosphate supply to the US will be even more limited. Adding to the list of concerns, prices for phosphoric acid in Northwest Europe have risen as well. OCP set their Q2 price over $1,300 CFR. Combined with high cost of sulfur, prices for raw materials are increasingly a concern. Moving to the fundamentals. European natural gas prices fluctuate at 35 euros per megawatt hour level, similar to last week, but this level is high. Cooler than expected weather boosted demand, and geopolitical uncertainty added pressure. EU gas storage levels remain low at 43.7% full, well below 66% at this time last year. Reflecting this, EU lawmakers voted to lower the November 1 storage target to 83% from 90%, acknowledging tighter supply following a colder winter. On the geopolitical front, markets are closely watching stalled peace talks between Russia and Ukraine. US natural gas futures fell below $3.4 per MMBtu, the lowest in 2 weeks, mainly due to weaker short-term demand expectations and a drop in LNG exports. Warmer than usual weather forecasts through late May are expected to limit heating demand, while mild temperatures also dampen cooling needs, reducing overall consumption. Additionally, gas flows to LNG export terminals have declined from record levels in April, amid seasonal maintenance. On the other hand, average gas output fell from record levels in April. Meanwhile, Energy Information Administration data showed last week's storage build was much bigger than usual because of mild weather. Agricultural commodities future prices were all in red at the end of last week. Wheat futures dropped more below $5.25 per bushel as improved yield prospects in the US plains pressured prices. Though strong export demand helped limit losses. Favorable weather and timely rains in Kansas boosted expectations for the best yields in 4 years. Analysts said that with improving crop conditions, a major rally in wheat is hard to justify. Still, China's warning of high-risk dry, hot winds next week raised concerns about potential crop damage in key producing regions like Henan. This introduced fresh uncertainty into the global wheat supply outlook. May WSD report had a first look into 25-26 harvest, and expectation for global production is that it will be about 8 million tons more than 24-25 amount. Most of this increase is expected to come from European Union, where several countries are having extremely bad year now. However, the next one should be better. At the same time, US production is projected to be lower by almost 1.5 million tons versus 24-25 figure. Corn futures dipped to $4.3 per bushel, its weakest level in over 5 months, as the May WSD report underscored a supply glut that overwhelms even a strong demand. USDA projects a record 401.85 million tons US crop in 25-26 marketing year, planted on 95.3 million acres at an unprecedented yield. Globally, output is set to reach a record 1.27 billion metric tons, driven by Brazil's robust safrinha and expanded harvests in Argentina and Ukraine. While US exports are forecast at 195.8 million tons, a multi-year high, and domestic use for ethanol, livestock, and industrial purposes is expected to climb versus a year ago, the sheer scale of production and inventory accumulation has swamped consumption, maintaining downward pressure on prices, even as traders watch summer weather for any threat to yields. Soybeans futures tumbled below $10.5 per bushel amid a sharp drop in soy oil prices driven by uncertainty over US biofuel targets. The drop came after renewed concerns that US tax credits for biodiesel may not support aggressive renewable diesel volumes, with reports suggesting next year's targets could fall below the 5.25 billion gallons proposed by industry groups. Earlier optimism had been fueled by easing US-China trade tensions, but sentiment quickly reversed as biofuel policy uncertainty resurfaced. Additional pressure came from fears that unresolved US-China trade talks could slash US soybean exports by 20%. On top of that, May WSD report suggested that next year global production will increase by 6 million tons, mostly driven by Brazilian production. Moving to the shipping industry. Containerized freight index increased by more than 100 points last week. Rates of container shipments from China to the US surged amid positive signals regarding US-China trade negotiations. Freight rates from Shanghai to New York increased by 19% to $4,350 per 40-foot container. And rates from Shanghai to Los Angeles shot up 16% to $3,136 per 40-foot container. At the same time, rates from China to Europe slightly dropped. Market analysts expect an increase in Trans-Pacific spot rates in the coming week due to shortage in capacity. The Baltic Exchange Dry Index continued its upward correction. The Capesize market closed the week on a firm and optimistic note. It jumped by 14% versus a week ago, mostly due to positive developments in the Atlantics. At the same time, for Panamax market, it was a lackluster week, more noticeably in the Atlantic, as limited demand was met with an increasing tonnage count. Ultra Supermax segment was also not very active in both basins, as well as Handysize market, which saw minimal visible activity across geographies. In the continent and Mediterranean market, fundamentals remained soft, with sentiment stayed somewhat positional. In the South Atlantic, market remained largely balanced. In Asia, a slight increase in the tonnage count was noted, but cargo volumes have helped keep rates steady for now. To sum up, Chinese urea and phosphates export policy has stirred the market, and we will see the reaction unfolding within an upcoming week or two. Chinese urea exports will be smaller in volume than expected, but target minimum price looks very challenging to achieve. Phosphates export will be robust in terms of volume, but again, price target is high, indicating that the market should not expect any price softening in Q2. Now, the regular puzzle of next Indian tender timing and volume needs to be solved, and then market will obtain clarity regarding reset values in 2025. Ammonia segment continues suffering because no significant demand support appears either east or west of Suez. Gas price in Europe fluctuated at a similar level, while in the US price dropped due to decreasing domestic consumption and LNG exports. Agricultural commodities future prices dropped more amid bullish production forecast in the latest May WSD report for the next marketing season of 25-26. Container shipping price from China to the US rebounded as a response to positive signals regarding trade negotiations. Bulk shipping was also in a positive mood, especially in Capesize segment. So let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.